Hey traders and investors, welcome back to the channel. Today, I'm sharing an exciting another trade I just made, a long-dated NIO call option with a $5 strike, expiring January 15, 2027. I paid just 72 cents per contract. Is this an EV moonshot or a smart play in a volatile market? Stick around as I unpack everything, from strategy to risks and future projections. What's a call option? For those new to options trading, a call option gives you the right, but not the obligation, to buy a stock at a specific price before a certain expiration date. In my case, I bought the right to buy NIO at $5 per share anytime before January 15, 2027. This trade is essentially a bet on NIO rising well above $5 before that date. Why NIO? NIO Inc. is one of China's leading electric vehicle manufacturers. While Tesla dominates headlines, NIO's innovation in battery swapping technology, premium designs, and government backing make it a serious player in the EV space. The company's expansion into Europe, potential margins in energy services, and strategic investments paint a promising picture. Right now, NIO's stock is volatile, but that's why options can be attractive. If the stock is trading at, say, $15 by January 2027, my $5 call would be worth at least $10, more than 14x my initial premium. Why a long-term expiry? I chose an expiration date nearly 2 years out to allow enough time for the market to correct itself and for NIO's business to potentially scale. Longer-term options, also known as LEAPs, long-term equity anticipation securities, are great for giving your thesis time to play out. Especially in growth industries like electric vehicles, patience can be a huge advantage. What are the risks? Options aren't free money. If NIO fails to rise above $5 before 2027, or worse, falls further, this option could expire worthless and I'd lose the $70 I invested. There's also market volatility, regulatory challenges in China, and global competition in the EV space. But for me, this is a controlled risk with asymmetric upside. I'm not going all in. It's part of a diversified portfolio. My strategy breakdown. I didn't jump in blindly. I looked at technical levels, historical support around $5, and macro trends in the EV industry. I also considered implied volatility and the options Greeks like delta and theta to gauge risk, reward. The 70 cents premium reflects market sentiment, some interest, but cautious optimism. This trade gives me exposure to NIO's potential rally without needing to tie up a large amount of capital. If things go south, my loss is capped. If NIO stays at or below $5 by expiry, the option expires worthless and you lose your $70 premium. But if it climbs higher, profits surge. At $10, you earn over 6x. At $25, returns explode nearly 28x. It's a bold trade with limited risk and massive upside potential. Comparing other strategies, could I have bought shares instead? Yes. But buying the stock would have cost much more upfront. Options offer leverage. You control 100 shares with just $70 while still maintaining flexibility. I also considered shorter-term calls, but volatility made long-dated options more attractive. Selling puts or credit spreads? Maybe later, but for now, I wanted pure upside exposure. This NIO call option is more than a trade, it's an experiment in long-term thinking. Will EV adoption soar? Will NIO execute on its vision? Only time will tell. But in the meantime, I'll track this journey and share the lessons as they come. If you found this useful, give it a thumbs up, drop a comment with your thoughts on NIO, and hit that subscribe button for more insights into options trading and emerging market trends.